Hi, everybody. Welcome to the Disruptive Diner. It is April 15th, 2014, tax day. We are here at Lab 1500 in St. Louis, Missouri for the conversation, Local Investment, Local Wealth. The purpose of this event is to have a really good discussion and talk about kind of what's going on with local investment, why that matters to us, and also then to figure out what we can do to work on it together. This really stemmed from some conversations I'd had with some people going back to last year when the Jobs Act first happened, which you might remember the Jobs Act was all about crowdfunding and all of these things and how this was going to change local business, which you probably cared about because you probably realized that local business is where jobs are overwhelmingly created and where wealth is overwhelmingly created. However, it's very difficult for investment to go there. And in fact, since 2008, banks actually lend less and less money because of some capital requirements and because of just some realities how that works. So there's a big push to figure out how do we get money into early stage companies, because early stage money, when people get those exits, that's actually where they get the bulk of the wealth creation happens there. And those early stage companies that are locally and regionally based are creating jobs. So there's some understanding that the greatest IT company in the world sometimes has very few employees compared to the revenue, and it doesn't necessarily do a lot for the economy. But we're not going to solve that problem by mandating it. What we're going to do is we're going to find out how to invest. So the topic today, local investment, local wealth. How can we make this be win-win for everybody? We got 3 speakers today, and the format for the Disruptive Diner is very simple. We ask each one of them to come prepared to do what's called a pachachkacha style talk, which is Japanese for chit-chat. It came about because Japanese architects like to get together and talk about their projects, but when everybody talked about their projects, there was no time to actually talk. So the idea is to get the presentation part of it done as quickly as possible and get on to the discussion where the real meat of it is. We have people here in St. Louis in the room. We have people in Peoria, Madison, and we have members in several cities throughout the region. And we never know where they're at, so people are watching via live stream. The 3 presenters you're going to see today are going to present 3 different topics or 3 different angles on how we can look at this topic. They've been asked to do this style presentation, which I believe only one of them has done before, and everybody else is a little bit wide-eyed about it. So cut them some slack because we asked them to do it to make sure we have plenty of time to talk and discuss. It's also a great way to introduce the idea. Their slides will be posted to SlideShare by the end of the day, and videos of these presentations will be posted to YouTube by the end of the week. So let's get started. The first person to join us is a guy named Jason Growe. Jason joins us. He's been kind of a civic leader, been involved in New Leaders Council and some other civic groups, so he knows a lot of people here in town. He happens to be an assistant vice president at Stifel, which is a brokerage and investment bank. And he's here really more to talk about from a civic perspective, and if you look at it from the perspective of how money moves around and everything and why it's good from a community. So so you guys know, he is not here to announce the formation of a Stifel fund to invest in your business. He is not taking email requests for that, and meetings for that will go nowhere. But he is going to talk about what it looks like to be win-win when we can think about how investment can work. So I'm going to get his slides ready. He's going to give us 20 slides, 20 seconds each, and then we're going to get into some discussion. If you're ready, are you ready, Jason?
I'm as ready as I'm going to be.
All right. And go.
Great. Well, thanks, Dan, and thanks, everyone, for joining me here today. Just a quick bit on my background. Work at Stifel in the private markets group. We do fund management. We also help early stage companies as well as middle market companies access capital. I just want to talk a little bit today about one, sort of the topic of the day, why invest locally, what benefits does that have, move into what that looks like here in St. Louis, and as much as St. Louis is sort of a good example for an emerging early stage scene, and then talk about some trends nationally and how that also impacts what we see here in St. Louis. So when we think about investing locally, there are certainly a lot of advantages, the first of which is to keep money in the local economy. There's certainly no doubt that $1 that's invested here locally stays here, circulates through the economy. The money you spend at the boutique coffee shop down the street is going to go, those profits are going to stay here locally as opposed to some other national chain where those profits go someplace else. So to the extent that there are quality businesses that you as a consumer want to purchase at and also perhaps want to invest in, you have the added benefit of knowing that money stays here locally. The other thing that I think is important to notice here is that there is quality deal flow here in the St. Louis region and in many regions across the country. And what do I mean by deal flow? It's just the investment opportunities that really flow your way, whether that's through word of mouth, you find out about it on the internet, whatever it is. There are quality companies built across the country and around the world. It has never been cheaper to build a high-tech company than it is today, and that's why you see cities like St. Louis, Peoria, Columbia that are starting to create their own companies, home-grow their own companies that are ripe for early-stage investment. So there are opportunities, instead of reading about the Instagrams of the world in the New York Times, you can find perhaps the next Instagram right here on Long Washington Avenue. So what does that look like in St. Louis? St. Louis, I think, is representative, as I mentioned earlier, of a lot of other emerging tech scenes, especially throughout the Midwest. And so just to give you a sense of the opportunities that might be available to the people in this room and watching from a distance, what does that look like? First, there is sort of like the angel investing. In St. Louis, we have a couple of different angel organizations. We have the Archangels and a little bit ahead of myself, but the Billiken Angel Network. Both tend to be associated with those universities. The Archangels tends to be associated with Washington University. The Billiken Angels, people might be able to guess here in the room, is associated with St. Louis University. So that's the opportunity to provide early stage companies with perhaps its first round of financing. So you're getting on the very ground floor of that. So if you're interested in finding those really raw, really unique new opportunities, that's a good stage for you to invest. The other place to look, and I sort of foreshadowed it a few seconds ago, but it's also universities. Universities tend to be a great innovation lab in the sense that it just lets students a lot of times go and create things, create new research projects, create new discoveries, whether that's in pharma or whether it's in technology, and commercialize those things. You then move into sort of the what I call early stage opportunities post-angel round, things like Capital Innovators, which is a local accelerator program here where they get $50,000 worth of investment and in addition to that get 12 weeks of sort of growth on hybrid to accelerate the growth there. Arch Grants is a local but now internationally known business plan competition where you get $50,000 in grant-free or equity-free financing. If you want to invest through a nonprofit, Arch Grants is a nonprofit, and so that's an opportunity for you to make perhaps just a contribution to the local economy. Then after that, you have sort of what I call early stage investors like Cultivation Capital. Cultivation Capital is an early stage firm that makes investments sort of I've seen them do sort of the $250,000 to $500,000 range, although I've seen them go above and below that in companies that perhaps are starting to get a little bit of traction. BioGenerator is a little bit different. It is similar to an accelerator program, but it makes sort of the same amount of money in terms of equity investing into early stage companies that are healthcare and life sciences companies, life sciences being drug discovery or perhaps even ag tech. And then after that, there's sort of the Series A. And this is the problem that a lot of people in St. Louis are talking about, and I'm sure people across the Midwest are talking about. There really is a lack of Series A financing here in the middle part of the country, which I'll define anything east of Sand Hill Road in Silicon Valley and west of Route 128 outside of Boston. That's the middle of the country. And so that's where the problem begins. And so that leads us into trends that we're seeing. That's sort of the first trend here, is that we're seeing all this excitement happen in the early stage investing because people read about it in the media and they want to get involved. But then what happens is you've raised $250,000, you've raised $500,000, and you need $3 to $5 million to get to your next stage in growth, and there's this crunch. There's a whole lot of supply for Series A financing, but there's a whole lot of demand to access that money, but there's not a whole lot of supply in terms of getting it there. And so that combined with the fact that we've seen a decrease in venture funds since the collapse in 2008. I think there's only 40% of the venture funds are left, has led to people saying, what else can we do to access growth capital? And one of the things that's come to the forefront is a major regulatory shift, which is the Jobs Act. And I'll focus mostly on Title II here for this conversation today, although I'm happy to talk about Titles 1 and 3. Title II of the Jobs Act essentially allows a privately held company to offer private securities through general solicitation and general advertising. This is a huge regulatory shift in as much as since 1933, during the New Deal, you weren't able to do that. And so what comes next, I think the Jobs Act is what comes next, and these alternative ways of financing companies that can't get that Series A money. How do you approach the general marketplace with your private offering? How do you reach those people, I think is sort of the big question here. And with that, I'll open it up for some conversation.
Great. So great job. You did a perfect job of keeping up with it. So you talked about a couple of things, and by the way, if you're on the call, you can tweet or text me with your questions. First question, you talked a lot about high growth companies and, talking about tech companies and everything. So you're still talking about companies that are like in this venture world, that the old model used to be you go through all the venture stuff and everybody's exit is an IPO, right? Is that changing now?
Well, I think the exits for a high growth company, they're not changing, but they're evolving. The trends there are evolving. So for a long time, I would say from we'll call it 2001, from the dot-com crash all the way through maybe the early part of 2013, the only option for most companies in terms of an exit was actually an acquisition by some sort of strategic acquirer, perhaps with secondary buyouts, so some new private equity firm comes in and buys you or whatever it is. And that limited exit opportunities and opportunities for liquidity for the early investors and for management and whatnot. What we're actually seeing, in thanks in part to Title I of the Job, not entirely, but in part to Title I of the Jobs Act, it makes going public, to your point, a lot less expensive and a lot less onerous upon the company. And that's why we've seen what's known as the IPO window open up over the past 18 months or so, particularly for pharma companies, actually. I think there seems to be a lot of investor appetite for growth stories because they're, perhaps they're tired of what's happening in the fixed income markets, or, I don't want to speculate too much there, but it's an opportunity to access liquidity besides the acquisition route.
So let's touch on that.
Yeah.
So you said you talked about liquidity events, and by the way, if anybody has any questions, just let us know and we can pass the microphone. But you talked about liquidity events, and then you talked about that investors might, the fixed income assets and things might, there might be some desire to move away from that. So what does the pain look like for an investor? So we talk about this as we need these. We need this investment to make these companies grow, but is this we're just, that this is only serving the entrepreneurs, or is this really good for investors too? Not that you're going to recommend anybody's fund.
Right, no. I get that. I'm just trying to think, the reality is investor is a very broad term, and every investor has his or her own or its own objectives in terms of what it wants to meet. And that lends itself to investing in higher risk companies, or it lends itself to not investing in higher risk companies. I think the reality is there's an appetite out there in the public marketplace for high growth stories right now. So overall, I think accessing the public markets and having this IPO window being open is a positive thing for the marketplace. And it also, quite frankly, it's another form of financing for these growth companies. A lot of companies that we're seeing go public over the past year or so are not profitable. And so it's not like they can live off their cash flows, but they need that next round of financing. Maybe they're to the point where they need $50 million to get to the next stage. And the best way to get that is by accessing the public markets for some of these companies.
Cool. If you have any questions, let us know. Go ahead. Oh, Dave, go actually.
Hi, I'm Dave Blankenship. I've got a guy I know who's looking to raise some money. However, I don't know that he qualifies in the areas you laid out, which I think are all the areas that make sense. But, it's something like an engine based on magnetics, but he doesn't really have a team. He's got his patent completely done, and he doesn't have traction. And maybe Arch Grants is the only way he can go. I don't know of other funding mechanisms that he's going to do. And plus, I don't know about me, which I would like to find something. If I get the guy funding of some way, is there a way for me to get a finder's fee or something without being in violation of SEC law?
So without getting into the point of, giving specific advice, can you talk just a little bit about where we're at as this is evolving? Because obviously we have some new opportunities, but are there, is there even more room for opportunity?
Yeah, well, first of all, I think I focused mostly on the tech and biosciences in terms of this presentation, sort of how I view the world, because that's in terms of the venture side of my practice, that's where I tend to focus. But there are venture funds that focus on all sorts of high growth companies. Just like, in terms, it sounds like maybe it's more, it's just a different type of fund that your contact would want to look towards. Maybe it's someone that deals with specialty chemicals or electrical equipment or things like that. There are funds out there for that person. In terms of getting involved, so without getting too much into the regulation, because I don't think we have time for it, and I don't proclaim to be an expert in it, the best way to help out a company, quite frankly, and get compensated for it, is to join that company. And perhaps your role is as a part of the management team to help find investors. You will have to evaluate whether that's something you would want to do, but that's always an option. There are regulations around who can offer securities and get paid for it, though. So I would just consult an attorney on that.
This tees us up, and I want to leave some time for other questions. Excuse me. So there's some speculation that to really grow economies and everything, that IT companies, they kind of live in a special little bubble where they are far more, their productivity, per employee is way higher than anybody else can actually sustain, and they're doing a lot to enable people. But that's not, we talked about, the number of Facebook employees compared to its market valuation is way out of whack compared to, Ford Motor Company. So do you see ways that are other sectors that are starting to become more popular, that people are opening themselves up to? Because I know from an investor perspective and venture funds, they always looked at these companies because they were the ones that had the best odds of an exit with, with big multiples and all that stuff. So do you see anything changing there, or do you think that that's a reality that the venture market is going to continue to serve things that are maybe not traditional companies?
Well, on the venture side, I think it is very important for early stage and growth companies to conserve cash. And so I'm not sure what we can do to get venture capital to change its mindset on that. And I would argue we probably shouldn't try to get venture capital to change its mindset on that. There is another form of financing, though, of equity financing, which comes in the form of more traditional private equity, which is buyout and growth opportunities. And there's a widespread opinions on the private equity industry, and there are good actors and bad actors, but the reality is private equity is a very healthy vehicle when used appropriately to help grow businesses, which tend to be more traditional businesses, quote unquote Main Street businesses that we think about, that hires employees, that isn't so worried about how much revenue compared to your employee count, things like that. It looks at, can we help the pet food company down the street grow a little bit, and things like that.
Because a private equity firm is looking at, they want to hold a company for a short period, they don't want to hold it forever. They want to hold it, they want to operate it, they want to grow its potential, they want to grow it and then have somebody that wants to acquire it.
Yeah, private equity firms are generally provided capital so they can help grow or improve the operations of certain companies, and that is good for the local economy. That is good for investors overall. So, investment, whether it's venture investment, private equity investment, angel, whatever you want to call it, it comes in many forms. They all serve its purpose.
Great. Keith.
Hi, Jason. Keith Polite. You touched upon the Jobs Act Title II. I know Title III is also coming down the pike, which potentially would open up non-accredited investors into the mix. Just kind of share your thoughts or fears or whatever about that, please.
I have thoughts and fears. So truth be told, I don't know enough about crowdfunding to really, I think, probably have a real opinion on it that's worth all that much. But I will say from what I do know about it, I'm not sure it's actually a sustainable answer. Nor am I sure that the SEC is ever really going to let it happen the way people envision crowdfunding to happen. I think there are a lot of investor protections that need to be baked in there. And maybe the SEC at some point in time says, okay, crowdfunding's okay, but you have to do these 10 things, whatever. And at that point, does it just become too onerous on the company to do crowdfunding? So I think the bottom line is I think the jury is still out on crowdfunding, and it's going to take a little time before we figure out what that looks like. Yeah.
Yeah, there are. I know here in St. Louis there's a group called iSelect Fund that's trying to make it so that accredited investors can more easily have liquidity events and be able to vet deals and things like that. But for unaccredited investors, if you look, there's actually starting to be some blowback on Kickstarter, even for the non-equity things, but just reward-based crowdfunding. When those companies aren't meeting their milestones and things, that there's some blowback. So I think that's going to change. One last question. We're going to get to Galen next, who's going to talk a little bit about what they're doing with Justine Peterson, which is some stuff that's a little bit more traditional business, more grassroots and everything, but also an interesting story of how they're using, kind of the political and regulatory and civic environment. So what do you think about the idea of pension funds and all of the public money that's out there? Do you think there's an opportunity to start putting that into local stuff?
Yeah, and I think that's probably that's like a whole other disruptive diner thing, which I would love to be a part of. There's a lot of conversations about this, and through other activities I do, outside of my work, I know that in Jefferson City here in Missouri, there's a lot of conversation about what can the state of Missouri be doing to help what's going on in St. Louis, Columbia, Kansas City, and other places in Missouri. There are models of what's happening in other states. I know Ohio has some tax credit programs. I think Colorado may have some sort of a dedicated fund. And so the question is, how do you engage the pension funds, or the public pension funds rather, in investing locally? I think...
And really that's just institutional investors really at that point, right?
That's right, and it's institutional investors. I think there needs to be a recognition of the position that public pension fund managers are in. It is their job at the end of the day to make sure that they are producing the returns that are necessary in order to provide for the benefits that are owed to these public employees and what they earn. And I think the reality is, if we're talking just about venture funds, venture funds are not in vogue right now. That's the returns over the past 10 years overall have not been that great. And not only that, the ones that have continued to survive post 2008, there's more money being plowed into the bigger funds, into the Sequoia Capitals, into the Kleiners, to things like that. So it is difficult to say to the Missouri Mosers, just to pick one, because that tends to be the flagship one. Hey, put your money into a $50, $100 million fund here in St. Louis. I think that's a difficult climb. And I would also make the point, it's not the most popular point that I've made around town here, I'm not sure St. Louis has the deal flow yet to support a $50 to $100 million fund. I think St. Louis probably has the deal flow to support a $20 to $25 million fund. And maybe 5 years from now, it can have that $100 million fund, that the deal flow is here and in the surrounding area. So I think, part of it is understanding their position, because they're not evil. They have a very sound foundation when they get resistant.
Yeah, none of us want to hear that our pension fund lost all of our money and we have to work until we're 90.
So that's part of it. Part of it is just understanding where the institutional marketplace views venture. It's not totally out, but it's not the best place. People do not view that as the best place right now in terms of alternative assets. And then lastly, I think the market will create the fund when it's ready.
Great. Well, let's give one more round of applause to Jason. Thank you very much. We are going to take a short break, and when we come back, we have Galen Gandolfi from Justine Peterson, who's going to talk about a much more grassroots approach to how we can fund some things and actually generate some local wealth. So thank you very much, and we'll be right back.